Brad Williams, Frugal Finance. Just a quick comment on what in the past used to be a worthwhile investment approach. Not so much today. It's called a direct stock plan or a dividend reinvestment plan, DRIPs and DSPs. In other words, when the industry was so focused on commission-based transactions, stock purchase commissions in the past were expensive. Very expensive. It could be 2 to 5% of every trade, and that's a trade in and out. Well, today, with free or zero commission trades, the direct stock purchase plans and the dividend reinvestment plans are sort of passé, but I just wanted to introduce them real quick to you. You had the option where you could buy directly from, let's say, favor Microsoft. You think it's a great company, and you looked into their plan, and they have what's called a direct stock plan where you could go directly to the company. You can buy Microsoft stock directly through Microsoft. The benefit there was you could save on commissions, but there could be some other transaction fees, so on and so forth. Today, you just go to any brokerage firm and you can ignore that because there's no commission. You can just buy Microsoft directly. Dividend reinvestment plans, these are, let me give you an example. BP, the oil company, they have some crazy structure. Keep in mind, this is a UK-based company and they're heavy regulated in terms of investor knowledge or investor information. And they have these reinvestment plans. They have these drip reinvestment plans that you could buy you could use your dividends to buy stock directly. And that still is the case in a lot of companies. Look into it. Let's just talk about a company that pays a sizable reinvestment. Let's say you own Costco, the retailer, and you own 100,000 shares. You just want the dividends reinvested. You could go and check to see if Costco has a dividend reinvestment plan. And that way you don't have to worry about it. It automatically is reinvested in more Costco stock. Now, if you say, well, I want to diversify away from Costco, well, then you wouldn't even consider this. You could also, to avoid just going through and worrying about this, you could check to see if they have a direct stock plans and they would purchase on a regular basis. It's sort of like dollar cost averaging. Direct stock plans usually will not allow you to buy or sell shares at a specific market price or at a specific time. Instead, the company will buy or sell shares for the plan at set times, such as daily, weekly, or monthly, at an average market price. Again, you have to look at that and you need to read average market price. Does that make any sense? Well, that average market price may be, let's say they have 30-day moving average and it's been very bullish, very high. You think that price is higher than the current market price. Would it not make sense for you just take care of and manage this yourself? I can't answer that. I just want to point out there's a lot of different tools out there. Again, this is from the U.S. Securities Exchange and more helpful tips. This link will be available below. There could be a link up at the right-hand corner that I'm introducing something related to this. Again, I just shoot from the hip sometimes and something keen will come up and I'll go, well, I'll just throw that in there. So just keep aware of that. Then also, when you review this, there's a lot of helpful tips here. Now, I'll have videos on most of this stuff, but if you're just curious, take a look. There's great tools here. And again, as I state, the calculators are fantastic. Protecting your investments is, again, more information I'll provide, along with a lot of information on introduction to investing. Brad Williams, Frugal Finance. Thanks for watching. See you soon.